Coming up in today's episode, the media claims the recession we're worried about is already ended. They're also saying the SP500 is going to keep going higher this year. Morgan Stanley raises its price target on NVDA to $500 a share. More problems at Disney. Jack Ma is apparently still alive and happy. Virgin Galactic says it's going to begin commercial space flights later this month. Larry Summers calls out the Fed's decision. The latest stock pick from big short investor Steve Eisman. And the S&P 500 puts in a dark cloud cover formation on heavy volume to finish out the week. Welcome back to Click Capital, everybody. I hope you're having a great Friday or Saturday wherever you are in the world. And what a week it's been with the market ripping higher and finishing a little softer here. Mega cap tech came off for the most part except for Tesla. And we're seeing a bit more support in the defensive sectors, utilities, healthcare, and consumer defensive. Not much out in economic data today. We did get the Michigan Consumer Sentiment Survey. Came in a bit better than expected at 63, indicating consumers are still feeling good about the economy. And then we've got the market shut on Monday for US public holiday. And we've now got pundits all over the internet claiming that because the stock market's been ripping really hard, we're not going to get a recession, and to forget about a hard or soft landing because they see a no landing scenario. However, those claims, just based on the last couple of months of price action, don't hold up too well against the data. And we've seen this time and time again. The market will rip and convince most people that this time is different. However, looking at all the US recession risk indicators, all of them are pointing to the upcoming recession except for truck shipments and jobless claims, the last shoe to drop. Every other time we've got this many indicators pointing to recession, we got the recession. Especially an inverted yield curve, which when you look back through almost 100 years of market history is pretty much every single time predicted the recession. And the yield curve is inverted and as deep as it's ever been right now. And some research shows correlation between how deep the yield curve goes inverted and how bad the recession will be. But admittedly, there is a lot of momentum in the stock market right now, and it's easy to see why we've got the media still saying that the S&P 500 will keep going up, and a lot of people still think there's a lot left in the tank here. Even one of the top investment banks on Wall Street, Morgan Stanley, still thinks NVIDIA can go up another 15% to $500 a share, and with this momentum, they very well could be right. However, some others in the industry are taking the other side of that opinion, with Bank of America's Harnett saying the stock market rally will be followed by a big collapse. And he said, "We're not convinced we're at the start of a brand new shiny bull market. This still feels like more like a combo of 2000 or 2008, where we had a big rally before the big collapse." And one thing that is definitely different between this rally in stocks and all the other rallies we've had in the last 15 years is that now you can easily find a higher return on bonds relative to stocks. That, with higher rates and central banks around the world switching from quantitative easing to quantitative tightening, where they've stopped flooding the system with liquidity, is what's structurally different about this market this time. Another news out today, Disney loses another executive with its CFO stepping down. And since we've had the return of Bob Iger to the helm, he has been struggling to turn this thing around. You can see that in the stock price of Disney. He's been struggling for most of this year, hasn't been able to keep up with the market's rally at all. And we further came off today 1.7% on volume with that news. And apparently Alibaba founder Jack Ma is still alive and happy, says the top executives from Alibaba. After he spoke out against Chinese regulators 2 years ago, they shut him down pretty good, along with a bunch of other billionaires and well-known business identities, some who are still mysteriously missing. And that's because China runs a hybrid capitalism socialism system where you're allowed to start a business and pursue economic freedom. However, if you get too big and influential, they will shut you down, as their government will always want to have total control over their companies. And apparently now Jack Ma, after creating one of the biggest companies in the world, is now teaching at a university in Tokyo. One of the most favorite meme stocks from 2021 is Virgin Galactic Holdings, which goes under the ticker symbol SPACE. It's going to finally start doing commercial space flights later this month, with the Edge of the Space experience to begin for ticket holders in August. And just looking at the stock chart, the market initially reacted really well. We gapped up 40%. However, that was from a really low $4 close yesterday, and the market sold off really hard on big volume. And just taking you out to a monthly chart, you can see how much it's come down off those huge highs we saw back in early 21 when we got up to 62 a share. And we've got a few people calling out the Fed this week, and one of them is an economist I do respect, Mohammed El-Iran. He said the Fed's latest policy communication was seen as confused and confusing, and that's because they did an unusual move where they held interest rates and then signaled hikes at the same time, echoing the same sentiment sentiment was ex-Treasury Chief Larry Summers, another well-respected voice in finance, also saying that the Fed's latest move is confusing and disturbing. He went on to say this meeting felt like it was driven as much by the internal political dynamics of the Fed as by any consistent and coherent reading of the economic situation, and that was a bit disturbing to me. He also said, I don't understand the internal consistency of an approach of pausing at this meeting, but then signaling 2 further rate hikes down the road, and signaling that they no longer expect unemployment to increase nearly as much as they used to expect it. And I agree totally with what these guys are saying. In my opinion, the market pitched a fat one to the Fed, which Jay should have hit out of the park. Inflation is still more than double their target rate. The jobs market is still okay. And we've got stock markets ripping to new highs. The market could have easily swallowed a hike, and he should have done it while he can, because if we do go into recession later this year and we've still got sticky inflation, he's going to have his hands tied behind his back in between a rock and a hard place, and potentially in a stagflation scenario like Europe is already moving into. And the big short investor Steve Eisman has made a new investment in infrastructure. And for those of you who already haven't seen it, I highly recommend watching the movie The Big Short, as Steve Eisman is played by Steve Carell, who does a really great job in this movie, along with Christian Bale, who plays Michael Burry. And it basically tells a story of the guys, traders and hedge funds, who actually profited from the collapse of the real estate market back in 2007 and 2008. And he said today he's not really interested in mega cap tech. And he said if anybody gave me their money today, for example, I wouldn't be so overweight tech. I'd be much more diversified. I'd have some, God forbid, bonds. And there's plenty of other stories other than tech. He said, for example, has anybody ever noticed that the electrical grid in the United States is pathetic? And so he's betting on a bit of a comeback in United States infrastructure, which a lot of other people share the same sentiment as well. Instead of spending trillions of dollars overseas in other countries, a lot of people would prefer the government to spend it at home and fix much of the crumbling infrastructure around the company. And the way Steve Eisman is doing that is investing in a utility stock called Quanta Services. And here's a look at Quanta Services on the chart. This is a monthly chart. It goes under the stock ticker PWR, short for power. And the stock is headquartered in Houston, Texas. And you can see it's already been on an amazing run this last couple of years, rising from 33 a share up to 185 a share. And our stock fair value has still got it a little bit undervalued, with fair value at 234 a share. There's other ways to play the infrastructure comeback in the States, and one of them I have on my watch list is the US Infrastructure ETF Infra, IFRA. And here's a look at the monthly chart, been consolidating here for a couple of years. And with that tick up in consumer sentiment today and those retail numbers coming in a little stronger yesterday, Fed Fund futures have increased the probability the Fed will hike on July 26 to 74%. But that's not stopping the stock market getting even more greedy today, with the fear and greed index ticking up to a super high level, 82 in the extreme greed zone. And that's once again to huge call option activity. Since we didn't get a big move in the final day of the quarter today with quad witching, didn't come in as busy as I expected. I thought we would do about 50 million contracts. We did just under 46 million contracts, but still a whopping 60% of calls, and that's why we've still got the fear and greed index really high. And nothing too exciting out of the dark pool trading index, with it just sitting slightly above neutral territory here. Corporate insiders still taking advantage of these elevated prices, lodging 3 times more sales than purchases yesterday. Okay, back to the charts, and it was rather uneventful end to the quarter and quadruple witching day. We did see a bit of volume and a few dark cloud cover formations out there in the market. That's when the market gaps up higher and finishes a bit lower down near its lows, creating this 2 candle formation here. You can see the market's really extended. We've already done a 13 count. Our swing oscillator is still well in overbought territory, and with the rest of the market catching up this last 2 weeks, those indices too are looking a little extended here. Here's the equal weight S&P 500 and the equal weight NASDAQ as well, potentially putting in these reversal formations today. Even the Dow Jones Industrial, which has been sideways for a long time now, put in a 13 count today on a reversal formation with volume, and the Russell 2000 has been stalling out for the last week as well. International stock indices are still overall weaker than US American indices, except for the Nikkei, which has been on an absolute tear this last 2 months. Got a bit of a perk up in the Aussie market yesterday and Chinese market as well, with that news that they lowered their interest rate and bringing in a big new stimulus package. It's got a bit of money flowing back into their market. And surprise, surprise, we got the VIX crush on Friday again, like we pretty much see every Friday going into the end of the week. With a lot of options expiring, it's really convenient for the option dealers for VIX to crush on Friday and just creates more worthless contracts for them. And so we've still got the VIX at super low levels, 13.5, just indicating how complacent the stock market is here. Bond market volatility has ticked down a bit somewhat. However, if I take you out to a monthly chart, you can see it is still well elevated relative to stock market volatility. If we look at the VIX on the monthly chart, we can see it's as low as it's been since before we had that huge uptick from COVID. The VIX is back down to late 2019 levels. However, bond market volatility as measured by the MOVE index is still pretty elevated. Short-term breadth's really elevated here with 88% of stocks above the 20-day average, and the amount of stocks making new highs has stallen out a little bit here and creating a little bit of divergence. Let's look at growth sectors versus defensive sectors spread, and the growth versus value spread appears to be stalling out as well this last couple of weeks. We've got smalls versus bigs coming back down at their 50, looking to defend these big green candles here. Nice little bump up in commodities versus stocks, and there's the government 2-year yield holding firm at 471. Same with the December Fed Fund futures contract, still ticking up in a little bit of a parabolic uptrend now. High yield bonds pulled back a little bit and still nowhere near as excited as the stock market. The dollar trying to find its footing back in this big support zone. And there's Bitcoin. We've got a little bit of a tick up today after we got that news late yesterday afternoon that BlackRock has actually partnered with Coinbase to try and launch the first spot Bitcoin ETF into the market. Filed an application with the SEC at the same time the SEC is suing Coinbase and Binance, creating a very confusing and messy situation in the crypto market. And how exactly does the US government and regulators think about it, and do they accept it or not? Nobody really knows. And look at the commodity index tracking ETF DBC. Before you know it, it's bounced up above it the 50-day as it didn't want to give up this big support zone, and that weaker dollar's really helped to find a floor in commodities, and we can see that in the price of crude as well, bounced off those mid-60s. And agricultural commodities continue to rip up, although we're a bit overbought up here, and uranium still trading firm as well. Over the stock sectors today, and mostly red out there except for the commodity sectors and a few defensive sectors like utilities was one of the better performers today, and a little tick up in staples as well. So we can see those growth spreads stalling out and a bit of money moving back into the defensive sectors here. And we can see the aerospace and defense ETF ITA still trading really well near all-time highs as the government is set to increase spending in defense while they put a pause on everything else. There's a look at the AI ETF bots putting in a little bit of a reversal candle. Same with semis as well, but still too early to say whether it's topped or not. It's not really a strong topping formation yet. And got a little bit of a turn down in BlackRock as the market didn't seem too excited about the prospect of them launching a new Bitcoin ETF. And there's a look at JP Morgan just sneaking up to its highs for the year and could be ready to break out from these levels. Tesla continues to defy the market, finding new highs for the year today at $263 a share, and the best performer out of all the big guys. But we are still super technically overbought here at 23 on our swing oscillator. And that's the most technically overbought Tesla has been now since November 2021 when it topped out. And we're now back at a market cap over 800 billion. There's a look at NVDA, rather small range today. We have got a little bit of divergences building here, but again, still too early to say whether it's topped out or not. Similar story with the other big guys. Apple, Microsoft, Amazon, and Google all pulled back a little bit today on above average volume, and a bit more so in AMD and Netflix as well. And there's a look at C3 AI, which has more than doubled in price over the last month. Really overbought up here, and we've got some strong bearish divergences on our indicators forming. And there's a look at Coinbase, which bumped up a little bit today on that news of partnering with BlackRock. I would have thought it would have ripped much higher, as that should have been a big vote of confidence in Coinbase and the fact that maybe they can still survive the lawsuit from the SEC. However, the market only marked up the stock 2.4%. Intel's been playing a bit of catch up this last week. Got an upgrade from analysts saying they too can compete in the AI game. And there's another look at one of my short favorite Royal Caribbean cruises, just coming off a little bit today. Did a 13 count yesterday, which means we were really technically extended here and got a big bearish divergence building as well. And a little bit of a pullback in the banks today, but they're still holding up rather well. Our SP 500 oscillator as at a very extreme reading, 64.8, indicating the market is really overbought. And here's a look at the S&P 500 on the weekly chart. Still just above 4,400 here. We're now sitting right at the top of the golden pocket, and that's a 65% retracement of the initial bear market move down. And just a look at the NASDAQ on the weekly time frame as well. You can see on our swing oscillator, it's the highest overbought level reading we've had in a couple of years. You'd have to go back to late 2019 to see the same numbers. And it's currently gone a bit past the golden pocket, heading towards the last retracement level at 78%. And what an interesting time in the market. We've got a lot of people proclaiming a new bull market. And then on the other hand, we've got a lot of billionaires still saying we're going into a recession. But at the end of the day, no one really knows exactly when this will top out. And who knows, we could potentially go into a big epic double top and even retest the November 2021 highs this year. Or we could topple over sooner than that with the Fed keep on hiking rates. But one thing's for sure, we are super technically overbought support on the NASDAQ and mega cap tech stocks. The rest of the market, which is pretty much 99% of stocks out there, still haven't been able to find new highs for the year, and we can see that in the equal weight S&P 500. The Dow Jones, which is only just at the top of its high now. Mid caps still well below that February 2 high, along with small caps and micro caps as well. So the question is, how much further does this skinny bull run, led pretty much by 7 stocks, going to last? I guess the big thing is what the Fed's going to do, because tech stocks really don't like rate hikes, and that eventually will have to eat into the sediment if the Fed does keep jacking rates, like they probably will next month. But I think we're just going to have to see a proper blow off top in this AI theme that we're going on before that potentially could happen. So again, just another tricky, challenging time in the markets. It's hard to say with conviction one way or another what type of market this is. And I guess we'll just have to keep playing it day by day, week by week as we see it. And finally, there's just a look at the global net liquidity model. Ticked up a little bit this last week, but still a big 600-point gap between that and the market. And with that, I'm still staying position 60% net short, but of course very diversified and selective with both the longs and shorts. And that's all for this week. I hope you guys have a great long weekend. Remember, there's much more to life than trading and staring at the screen all day. I like to contrast the digital side of life by getting into the outdoors, so I'll be doing a few mountain hikes this weekend, and I always find it refreshing just to get away from the screen for a few days. So I hope you have a relaxing weekend as well. Thanks very much for all your support of this channel. I really do appreciate it. And I hope to see you again on Tuesday afternoon. Cheers.